Welcome back. You're watching Money, Money, Money coming to you from Bengaluru, and with us we have two experts, Rakesh, Rawal and Lovaii, Navlakhi, and we also have two investors with us, Mr. P.R. Chandrasekhar as well as Mr. Sanjay Kandwala. So I hope you all have had an interesting time so far. I know I have, but before the break I actually asked a question about how much diversification is too much diversification. This is something I want to ask both of you, because a lot of people who call in sometimes on the show, they say that, they've invested in 20 mutual funds, they have like 30 insurance policies, and they say they're diversified. So all they have actually is one asset class. So how much diversification therefore, Rakesh, is too much? Where should someone draw the line?
Well, if you really look at worldwide wealth of HNIs, that's about $44 trillion. That's about 19% in real estate, close to about 30-35% in equity, about 8-9% in alternative assets, and the rest is in debt. Right? This is how the cumulative numbers of HNIs the world over stack up. Right? Now, I think that diversification is an offshoot of what kind of return objectives you set for yourself. And return objective is a direct offshoot of your aspirations, or whatever you wish to do, and where you see your money. But certainly, I think diversification is very, very important, also from the return, also from a risk management perspective.
Fair enough, but Lovaii, is there a rule of thumb for everyone else, all of us who are not HNIs?
I don't think there's a rule of thumb for anyone, because I feel that every person needs to have a different sort of portfolio depending on what their needs are. So let me try and give you an example of what is not diversification. So in 2007, we had people who were retired, very happy with the real estate asset class, and saying that, 90% of my post-retirement requirement is coming from property rentals, and they are into 4 or 5 different properties. And what happened is real estate took a crash. I know of a particular client who had 4 properties. 2 of their properties the tenant vacated. So suddenly, instead of 90% of the need, it dropped to about 50-55%. And it took close to a year with a fall in rental for the person to get back the property on rent. So I think people tend to think that just because I have many of one particular class, so I think asset class diversification is probably more important than within the asset class.
So you want to talk about how often do you review your portfolio?
Well, we review it every month. But it's not that each time you review your asset allocation and things like that. You just go over the numbers, and if there is any major change that is needed. But the question, maybe going back to the previous segment, is that when you see a market either improving or going down, you have a tendency to change your asset allocation between, say, debt and equity or what have you, to suit that trend. Now, the real thing probably is to resist it, but it's very difficult. So, what's your take on that?
Very simple again. I'm harping on the same thing, and I will continue to harp on the same way of managing money. It has to be objective oriented. So if you've got a 12% objective, and if that can be achieved with a certain asset allocation, then so be it, right? And if the markets are helping you, excellent. If they're not, be patient. They will ultimately help you. So the point is that, your asset allocation is an offshoot of your return objective. So if you're happy with that return objective, then get there with the least amount of risk. That's the principle that we follow. Now, if, for example, you believe that, hey, I need to change my return objective for whatever reason, so let's change it in a conscious manner, and then change the asset allocation in the same fashion. Now, I think that we have to move away from the drift mechanism of management to a well thought through mechanism of management. Another thing that is very, very important is in asset classes is, especially equity, is what kind of valuations the markets are sort of trading at. The fact of the matter is that if you are very much off the average on the high side, certainly your risk levels are far greater as compared to if you are much below the average valuation. At which point in time you need to be very careful in terms of what kind of allocations you've given to equity, and there are hedging mechanisms that you can also incorporate to make sure that if in case of some events leading to downside of markets, your fall is not as hard as would have otherwise been.
So we're going to take another quick break, and when we come back, we're going to tell you a little bit more about how to keep emotions out of investment.